Okay, so you're here with us because you want to get smart, fast, right on these potentially complex topics.
That's right.
And today we're going to do a deep dive on something pretty well known, but sometimes still shrouded in a bit of mystery. Uh,
I agree with that.
it's an investing strategy, can slim.
Exactly. And, forget the latest meme stock craze. We're going a little bit old school here in a smart way.
Yeah.
So Can Slim was developed by William J. O'Neill.
Okay.
He's the founder of Investors Business Daily.
Right.
And it's a really systematic approach to identifying growth stocks before they make those huge upward moves.
I like it. So this is not some theoretical framework
Yeah.
cooked up in an ivory tower.
Not at all.
O'Neill and his team actually did the work.
Right.
They went and they dug through the data
They did.
on hundreds of past stock market superstars,
Yeah.
going all the way back to 1953, all the way up to 2001.
That's right.
So that's a pretty good sample size
Very good.
to be working with. And they wanted to know, what did these winning companies look like before they became winners?
Yeah, that's the key question.
So that's what we're going to try to figure out today.
Exactly.
So for you, our mission today is to break down this acronym CAN SLIM
Right.
to really understand the logic behind it.
Yes.
And the critical criteria behind each letter.
Each and every letter.
Think of this as your shortcut to grasping what I think is a really influential investment methodology.
Oh, absolutely. It's been very influential
Yeah.
for a long time.
Okay, so the sources that we're going to be looking at primarily are a book by William O'Neill called The Successful Investor.
Right.
And then also particularly helpful, I found, was an appendix within the book,
Okay.
which has an article by John Badkowski.
Yeah.
And he specifically dissects the Can Slim method.
That's right. And that's really, because that's my first introduction to Can Slim.
Okay.
Was that appendix.
Interesting.
Yeah. So that's really helpful.
I like it. So these are like the foundational texts that O'Neill himself laid out.
These are the ones, yeah.
Okay, let's get into it.
Let's do it.
CANSLIM. Each letter represents a key characteristic that O'Neill and his research found to be consistently present in stocks right before they really took off.
Nice.
So it's like building a case
That's right.
for a stock. The more criteria you find,
The stronger the case.
the stronger the case becomes.
Yeah.
Let's start with C.
Okay.
Current quarterly earnings per share.
And this is where it all starts, really.
Okay.
With O'Neill's research, with the most recent snapshot
Yeah.
of the company's profitability.
Okay.
And the fascinating thing is it emphasizes a really substantial percentage increase in earnings per share.
Yeah.
But you compare it to the same quarter
Yeah.
in the prior year.
Right.
So O'Neill found that this significant jump is a crucial early indicator.
Okay.
It's not just being profitable.
Yeah.
It's demonstrating like explosive growth right now.
Right.
A key trait that he found again and again in stocks before those major breakouts. And he's talking about a minimum increase of 18% or even 20%.
So this is not just a little like tick upwards.
No.
It's got to be a surge in profit.
Surge, yeah, absolutely.
And it's also important to look beyond just the headline numbers, right?
Right.
To strip away any kind of unusual or one-time gains.
Extraordinary gains.
It's extraordinary gains to really get a sense of the company's ongoing operational performance.
Absolutely.
Yeah.
You want to see the core business really firing on all cylinders.
Yeah.
And even more compelling than a strong increase
Okay.
is accelerating growth.
Oh, I see what you're saying.
So if the earnings growth rate this quarter is higher than it was the previous quarter,
Yeah.
that's a very powerful sign. It suggests momentum is building.
It's gaining speed.
It's gaining speed, yeah. Think of it like a snowball rolling downhill. It's getting bigger and faster.
I like that analogy a lot.
Yeah.
And then also the sources that we've been looking at, particularly in the third edition of O'Neill's book,
Okay.
mention a secondary factor
Okay.
related to sales growth. Can you talk a little bit about that?
Yeah, so this is a really important refinement.
Okay.
So the third edition introduces this idea of looking for quarterly sales growth
Okay.
of 25%
Yeah.
or even an acceleration in the rate of sales percentage improvement
Okay.
over the last 3 quarters.
I see.
And the logic here is that strong earnings
Yeah.
often follow strong demand
Right.
for a company's product or service.
Yeah.
So if more customers are buying what they're selling,
Right.
that can be a strong leading indicator for future profitability.
Makes sense.
It adds another layer of confirmation.
Confirmation, I like it. And it wasn't just about finding like one company with these impressive numbers in isolation.
No, right.
There was something about the broader industry too.
Right. So O'Neill stressed the significance of finding at least one other stock
Okay.
in the same industry group
Okay.
that's also exhibiting this strong quarterly earnings growth.
Okay.
If multiple companies in a sector are showing similar strength, it suggests that the entire sector may be benefiting from favorable tailwinds,
Right.
making your chosen stock even more likely to succeed.
So you're looking for a tide that lifts all boats.
They're looking for the rising tide that lifts all boats.
I like it. Okay, so we've thoroughly covered C.
Yeah.
Let's move on to A,
Yeah.
annual earnings increases.
Right.
This shifts the focus right from the immediate quarter
Yeah.
to the longer-term trend of profitability.
Exactly. Yeah, so here, the key metric is the annual compounded growth rate for EPS over the past 4 or 5 years.
Right.
And O'Neill's research indicated that truly successful growth stocks typically demonstrate a rate of at least 25% per year over that period.
Okay, so over a significant period of time.
Significant period, yeah, absolutely.
Showing consistent growth.
Right, it's not just a flash in the pan. This shows a history
Right.
of significant profitability growth.
Yeah, and it wasn't just the overall average growth rate, right?
That's right.
Ideally, each of the last 5 years should show an increase in EPS.
Each and every year, yeah, compared to the year before.
Okay.
And this really speaks to consistency
Yeah.
and a reliable upward trajectory.
I like it. And then the third edition brought in some secondary factors
Okay.
to further kind of refine the A criteria.
Right.
Can you talk a little bit about those?
Yeah, so those include return on equity, ROE,
Okay.
of 17% or more,
Okay.
which tells you how effectively the company is using shareholder investments to generate profit,
Okay.
and then also annual cash flow per share,
Right.
exceeding actual earnings per share by at least 20%.
Okay.
And this suggests the reported earnings are high quality and backed by real cash.
I see. So ROE is about efficiency.
Efficiency.
And then strong cash flow is validating the earnings.
That's right.
Validating.
Okay, so the sources also noted the importance of earnings being stable and consistent year over year for the last 3 to 5 years.
Yeah, that's right. You don't want to see a roller coaster.
You want to see a steady climb.
Yeah, like a nice upward trend.
Yeah, exactly.
Not erratic.
Yeah. And then finally, a positive signal is if the consensus earnings estimate from analysts for the next year is higher than the current year's expected earnings.
That's right. So the experts who follow the company are optimistic
about its future profitability.
about its future. I like it. So A is all about establishing a history of earnings growth.
That's right.
Financial health.
Yes.
Okay, let's move on to N.
New products.
New products.
New management.
New management.
New highs.
New highs.
I like this one.
That's a good one.
It feels like it's tapping into like the catalyst for future growth and kind of the psychological aspect.
Optimistic market as
well. Yeah, that's right. So N focuses on those potential sparks that ignite significant stock price appreciation and positive market sentiment.
Right.
So it could be a truly innovative new product or service that's disruptive, you know.
Okay.
Or it could be a fresh, capable management team that brings new vision and execution.
They're shaking things up.
They're shaking things up, yeah. Or it could even be a positive, transformative change within the company's industry.
Interesting.
Yeah, and these are all factors that could significantly alter the company's growth trajectory.
Right.
For the better, of course.
Yeah, hopefully. And I think that the new highs part is particularly intriguing.
It is a good one.
And this isn't about buying a stock that's already, like, way up.
Right.
Right? It's about the timing.
That's right. It's about the timing of entry.
Yeah.
So you're looking for a stock that's breaking out to new price highs.
Okay.
After a period of consolidation.
Okay.
What the source calls a base.
A base. Okay.
Yeah. And this is a critical element of the CAN-SLIM method.
Okay.
Because O'Neill was a firm believer in buying strength.
Okay.
Not trying to pick bottoms.
I like it. So how do you know when a stock is breaking out to new highs?
So you're looking for a stock that breaks out to a new high.
Okay.
On strong trading volume.
Okay.
And after forming what we call a constructive chart pattern.
Okay.
So you could think of a stock price forming a base.
Okay.
As a coiled spring.
A coiled spring.
And trading within a relatively tight range.
Yeah, okay.
But then it explodes upwards.
I like it.
So that strong volume on the breakout day
Yeah.
really confirms the conviction of these buyers.
That they're behind it.
They're ready to go.
Okay, so we're looking for like a fundamental catalyst, the new aspect.
The new aspect.
But then also a technical confirmation.
Exactly.
In the stock's price action and trading volume.
That's right.
Okay, on to
supply and demand.
Fundamental economics at play.
Absolutely.
In the market.
Yeah.
Okay, so can you talk a little bit about that one?
Yeah. So this element considers the number of shares that are available for public trading.
Okay.
The supply, which is often referred to as the float.
The float.
Yeah, and the level of investor interest in those shares.
Right.
That's the demand.
The demand, okay.
So while CAN-SLIM doesn't entirely exclude larger companies,
right,
the third edition of O'Neill's book placed a greater emphasis on stocks with a small or reasonable number of shares outstanding.
Okay.
Often referred to as a limited float.
A limited float.
Yeah, and this just means that fewer shares are readily available for trading.
Okay.
Which can amplify price movements when demand increases.
I see.
Because there just aren't as many sellers.
Right.
At lower prices.
Right.
And this is one of the reasons why a smaller company with a very limited float can really take off.
Yeah.
But the market's preference between those smaller and larger companies can shift over time, right?
Right. The source mentioned that.
Can shift, yeah, depending on the overall economic environment.
Right.
Different phases of the economic cycle and different investor sentiment can favor different types of companies.
Right.
So sometimes investors gravitate towards the perceived safety and stability.
Who our chip?
Yeah, of those large, well-established companies.
Right.
Whereas at other times, the higher growth potential of smaller, more nimble companies is more appealing.
Makes sense.
So you got to be aware of these broader dynamics that are at play.
And then there were some secondary factors related to S as well, like the level of insider ownership and the company's debt situation.
Exactly. So a large percentage of ownership by the top management team is generally a good sign.
Okay.
It suggests that their interests are aligned with those of other shareholders.
Yeah.
And similarly, if a company is actively buying back its own shares in the open market, it can be an indication that management believes the stock is undervalued.
I see.
And that they have confidence in the company's future prospects.
Okay.
Finally, O'Neill's research favored companies with a lower debt-to-equity ratio and those that were actively working to reduce their debt burden.
Right, so that they're in a strong financial position.
Yeah, less debt generally translates to less risk for the company.
Makes sense. Less debt provides more financial flexibility.
Exactly.
Okay, so let's move on to L. Leader or laggard?
Leader or laggard.
This one's pretty intuitive, right? You want to be invested in the best performing companies.
That's right.
In the strongest sectors, not the ones that are trailing behind.
Yeah, the core idea here is to focus your investments in the leading companies within their industry group.
Okay.
So you want to identify and invest in the top 2 or 3 stocks in a strong and ideally accelerating industry group.
Okay.
And this is where relative price strength becomes really crucial.
And there was a specific benchmark or threshold for relative strength that the source mentioned.
Yeah.
What was that according to the third edition?
So the third edition placed a really big emphasis on relative strength. O'Neill suggested that a stock with a relative strength rank below 70% is generally considered a laggard and should be avoided.
Avoided. Okay.
And ideally, you should look for stocks with a relative strength of 80% or higher that are also in the process of forming that constructive chart base pattern that we talked about earlier.
Right.
So this relative strength rank
Yeah.
is a measure of how a stock has performed
Okay.
compared to a broad market index
Okay.
over a certain period of time,
Okay.
typically 52 weeks.
Right.
So a high relative strength
Yeah.
indicates an outperformance.
Yeah. You want to own the stocks that are leading the market.
That's right. Not lagging behind it.
Not lagging. And the flip side of that is that you want to be wary of stocks that consistently underperform during market corrections.
That's right, because true market leaders often demonstrate resilience even when the broader market is experiencing a downturn.
Right.
Laggards, on the other hand, tend to decline more sharply and recover more slowly. So yeah, be wary of those.
Okay, institutional sponsorship.
All right.
So now we're bringing in the role of the big players in the market.
The big institutions,
Right. Mutual funds, pension funds.
Hedge funds.
All those guys.
Yeah.
So can you talk a little bit about that?
Yeah, so these institutional investors often have substantial resources
Yeah.
dedicated to research.
Right.
And they can exert significant buying pressure on a stock.
Yeah, because they're the big money.
They're the big money. They're the whales.
Right.
So O'Neill suggested looking for a stock that is a reasonable minimum number of institutional owners.
Okay.
And he specifically mentioned 10 as a good starting point.
Okay, 10 institutions, but it's not just about the sheer number.
That's right.
Yeah.
It's about quality.
Okay.
You want to see a stock held by well-regarded and successful portfolio managers
Okay.
with proven track records.
Right, you want to see the smart money
You want to follow the smart money, yeah, absolutely.
going into the stocks.
That's right.
And then a trend of an increasing number of institutional sponsors.
Yeah,
That's a good sign.
that's a good sign. Yeah, it indicates growing interest and validation from that smart money.
Right.
Conversely, a decreasing number of institutional holders
Yeah,
could suggest that they're starting to reduce their positions.
I see.
So you want to be mindful of that. But the source also cautions against stocks that are overowned
Oh, interesting.
by institutions.
Okay.
So if a large percentage of a company's shares are already held by institutions,
Right.
there might be limited buying power remaining
To push the price up higher.
to drive the price significantly higher.
Right.
And it can also make the stock more volatile
I see.
if they decide to sell.
Yeah, if they all rush for the exits.
Exactly.
Okay, and then for individual investors like us,
Right.
how can we even access this kind of information?
So luckily, there's a bunch of resources that are readily available.
Okay.
Financial websites like Morningstar.com,
Okay.
the financial sections of major news outlets.
Like CNBC on MSN Money
Right.
often provide data on mutual funds
Okay.
and other institutions
Right.
that own a particular stock.
I see.
So you can see who those big players are
Yeah.
and whether they're increasing or decreasing their positions.
So valuable to know.
Very valuable.
Okay, last one.
Last one,
Market direction.
market direction.
This is the overarching factor, right?
The overarching, yeah,
It's like the wind in your sails.
the wind in your sails or the headwind.
Or the headwind that you're fighting.
Yeah, you're fighting against.
Right.
So while CanSlim provides a detailed framework for selecting individual stocks,
Yeah.
O'Neill always emphasized
Yeah.
that the overall direction of the market,
Right.
whether it's in a confirmed uptrend,
A bull market
bull market,
or a
a
downtrend.
bear market,
Right.
has a profound impact on the performance of even the best individual stocks.
Right. It's tough to swim upstream
It's yeah, it's very, very challenging to
yeah.
consistently get those returns. Right.
when you're fighting against the tide of a declining market.
Right. So how did O'Neill suggest that we figure out the market direction?
So his approach to gauging market direction was through technical analysis,
Okay.
looking at price
Yeah.
and volume action of the major market indexes
Right.
to determine whether the overall trend was constructive or corrective.
I see. So accurately assessing whether you're in a favorable or unfavorable market environment
Yeah.
is crucial
Absolutely crucial, yeah.
for deploying the CanSlim strategy.
Yeah. You could identify individual stocks that look great
Right.
and they meet all the criteria.
They check every box.
But if the market is in a significant correction,
Yeah.
the probability of them doing well is substantially diminished.
Right.
You really need the overall market to be at least stable
Yeah.
and preferably trending upwards
Right. To give your CanSlim picks a chance.
to give them the best chance of success.
So the first 7 letters give us the rules for identifying the potential winning stocks.
That's right.
But the M reminds us that we need to understand
Absolutely.
the overall market trend as well.
Yeah, can't ignore the macro.
Right. And so the source material that we've been looking at also provides some concrete examples.
Yes, it does.
Looking at actual stocks
Right.
that pass the CanSlim screen
That's right.
at a specific point in time.
Right.
So can you talk a little bit about that?
Yeah. So Table 8.2 in the appendix offers a snapshot of how these criteria,
Okay.
as interpreted in both the second and third edition of O'Neill's book,
Okay.
were applied to market data as of March 14th, 2003.
Okay.
So it shows you which companies met those standards
Right.
at that particular moment.
So in this case, the companies that they listed
Yes.
that met the criteria for the third edition
Right.
were Apollo Group,
Apollo Group.
FTI Consulting,
You take it healthy.
International Game Technology,
Yes.
and Teva Pharmaceutical Industries.
Right.
And the table detailed their EPS growth,
Uh-huh.
sales growth, annual EPS growth rate, Relative strength, number of institutional shareholders.
Exactly. And these are all the criteria that we just talked about.
Right. So this is bringing it all together.
And bringing it all together.
Showing us how the sausage is made.
That's right.
So, for example, Apollo Group showed a huge current quarterly EPS increase of 72.2%.
Wow, it's huge.
Compared to the same quarter in the prior year.
That's right.
And they also had really strong sales growth.
Yeah.
And a high relative strength ranking.
It was a winner.
It was a winner, right.
Yeah.
And then similarly, FTI Consulting demonstrated a massive 192.3% surge in current quarterly EPS.
That's incredible.
It's pretty amazing.
Yeah.
And so these are all companies that met the Can Slim profile.
That's right.
At that time, yeah. And then the second edition screen identified commercial bank shares.
Right.
And Oshkosh Truck. And so it's kind of interesting to see how the third edition, which had kind of refined and more demanding criteria,
restricted,
led to a different set of companies being identified.
Yeah, that's right. And a lot of those companies tended to be those larger, more established firms.
Right.
With greater institutional ownership.
Right.
And just overall stronger growth metrics.
Right.
So it's really interesting to see.
Yeah, it's interesting to see the evolution of the method.
Yeah.
In the different editions of O'Neill's work.
Yeah.
And the backtesting results that are briefly mentioned in the source also indicate that while the Can Slim methodology has historically shown strong and consistent performance across various market cycles, the third edition showed a little bit more volatility.
It did. It was a little more volatile.
In its returns. But the overarching conclusion is that these computer screens, while powerful for filtering a large universe of stocks, are really just an initial step.
That's right.
In the investment process.
They're a starting point.
A starting point. Yeah, they give you a list of candidates.
Yeah.
But further in-depth fundamental and technical analysis
by the investor
is essential.
Absolutely essential, yeah.
Before making any actual investment decisions.
Yeah, a computer screen can sift through a vast quantity of stocks based on specific criteria.
Right.
But it can't assess those crucial qualitative factors.
Right.
Like the quality and integrity of a company's management team.
Yeah.
The intensity of the competitive landscape.
Right.
Or any potential disruptions in the future.
Yeah.
That might impact the business.
Right.
So that's where the individual investor's own due diligence really comes into play.
So for you, the listener, our deep dive today has provided a comprehensive foundational understanding.
It has.
Of the Can Slim investment strategy.
Yeah.
It's a system that stood the test of time for decades.
It has.
It's fundamentally built upon the principle of identifying those specific fundamental and technical characteristics that have historically been present in stocks right before they experience a huge run-up in price.
That's right.
And importantly, remember that while the individual Can Slim principles are very specific.
They are.
And data-driven.
Yes.
The M for market direction.
That's right.
Serves as a critical reminder.
It's so important.
Of the overarching importance of understanding and aligning your investment decisions.
Yes.
With the prevailing macroeconomic and market environment.
You can't just pick great stocks. You got to pick them at the right time.
Right.
In a supportive market context.
So considering the historical performance of the Can Slim methodology across these various market conditions.
Yes.
What specific elements of this approach particularly resonate with your own individual investment philosophy and risk tolerance?
Good question.
And what further, more granular research might you now be inspired to undertake to determine if incorporating elements of Can Slim could become a valuable tool in your own investing toolkit? That's your thought-provoking challenge to consider.
Absolutely.
As you continue on your investing journey.
Keep learning.
Thanks for joining us for this deep dive.
My pleasure.